An article in January 2016 said that Dick Smith's Electronics could be in a whole bunch of trouble and might not even survive. So let's have a look from an accounting standpoint and use our Year 12 accounting knowledge to figure out what's happened. Probably more importantly, why is Dick Smith in trouble? So why has this bad news come out and can they actually survive at all? And also, were there any warning signs? So can we go back and look at the financial reports, use our accounting knowledge and figure out if there were any warning signs that Dick Smith was actually a business to be avoided instead of the big success story it was made out to be. So who is Dick Smith Electronics? It's a retailer of electronic devices. So they sell things like laptops, iPhones, TVs, home entertainment, small electrical, white goods and so on. They was started in 1968 by entrepreneur Dick Smith, but it's a much bigger business than that now. It's got over 400 locations around Australia and revenues in 2015 were 1.4 billion. So the question that we'd like to ask is, well, how can a business with revenues of 1.4 billion be on the cusp of going broke to the point where some people think it won't survive? One thing to remember is that Dick Smith is a public company, and what that means is it was floated on the stock exchange in 2013, and rather than being owned by just one or a few private individuals, it now means it's a public company and anybody in Australia or internationally can buy shares in it. So you could go onto the ASX website at any time and get the share price. So for instance here it is 35.5 cents. And you could buy as many shares as you like in Dick Smith's at 35.5 cents. But the problem there is, as a public company, there are some obligations that they have to follow. One is that they have to produce an annual report. And you can see the cover of it on the right. It's a big thick document, usually maybe 100, 150 pages. And that's got to be publicly available if you are on the stock exchange. And one thing that's in it, it's got a lot of stuff in it that's difficult to read, but one thing that's in it that should be easy to read with a bit of accounting knowledge are the financial reports. So Dick Smith will publish a balance sheet, an income statement, and a cash flow statement. Every business on the stock exchange has to publicly publish those. And they're going to be a little more detailed and complicated than the ones we do in Year 12 accounting, but fundamentally they're the same. So if you can read Year 12 accounting reports, you can read the public company reports for Dick Smith's. So the other obligation they have is they have to publicly announce all material information. So you can see on the ASX website there's a section called announcements, and for Dick Smith's, anytime there's something that's material, they have to announce it to the public so we can all know about it. And you can see there's a whole bunch of PDF files there with important announcements. But what does material mean? Material means we need to go back to the start of our course and remember the qualitative characteristic of relevance. And what that means is information is relevant if it helps us make decisions, but part of that is also the materiality test. We want to include or have all information that's large enough to influence our decision making, and anything that's omitted or misstated might result in a bad decision, and if it does, that information is material. So Dick Smith obviously has a lot of information that's material to its decision making, and that's the reason why a lot of people think it's in trouble, and this newspaper article came out. So who'd be making decisions about Dick Smith's? Well, you'd have the shareholders or owners. They want to know how their investment's doing. You've got potential shareholders, so people who might want to buy shares in the company. You've got the banks and other lenders, so they'll have loans outstanding to Dick Smith's. They'd like to know if Dick Smith's is going to be able to pay it back. Suppliers, again, they'll have debt. So for example, Apple, Dick Smith might owe Apple a lot of money for products that have been supplied. So they're going to want to know, can Dick Smith pay them back? The government, because Dick Smith employs a lot of people and they pay a lot of taxes, so the government's going to want to know, is this business going to make it? The employees, you'd like to know if you work there that your employer is going to be around. Otherwise, if not, you're going to have to start to make a decision about maybe you look for another job. And lastly, customers. Maybe if you're buying something at Dick Smith's or thinking about it this week, you might be a little bit hesitant knowing that the company's going to go broke, and that might make it hard to get your warranties and get any after-sales service. So, on the 5th of January 2016, Dick Smith on the ASX website listed a material announcement, and we can see it here. It's called ASX Market Release, Suspension from Official Quotation. Now, it's got a lot of fancy words in there, but fundamentally, this is something that we can understand. It's really simple. Here's the actual release, and it says, suspension from official quotation, the securities of Dick Smith Holdings, which just means their shares, will be suspended immediately following the company's appointment of a voluntary administrator. What that means is Dick Smith thinks it's in trouble. They're going to have to appoint a special type of accountant called a voluntary administrator to help them try and get through this crisis, if they can in fact even get through it. So what that means is you can't buy shares in Dick Smith's today. As of that announcement, the shares are suspended. They might come back on in a week, a day, 3 months, or they might never come back because the company doesn't survive. So the reason we want to look at how this announcement came about is to look at the share price. So in the previous 6 months, the share price has gone from over $2 down to 35.5 cents. So it's been really bad news for shareholders. Well, why? Because obviously the current shareholders want to get rid of the share, so they're prepared to take a lower price. And potential shareholders must be looking at the company and going, it's not going to be very successful based on what we can see, so we're not going to pay as much for their shares anymore. So specifically, how could we make good decisions? Were there any warning signs about this? And a lot of people don't have accounting knowledge and invest on the share market, and these are the people that are going to lose out. So once we've done Year 12 accounting, we know something called the debt ratio, and it looks at how do we finance our assets. Do we do it either with external funds, which we call liabilities, or do we do it with internal funds, which we call owner's equity? And it's a really simple ratio. We take our total liabilities and divide them by our total assets. Well, where can we get that info? Well, it's real simple. They publish a balance sheet, which we said is publicly available, and there it is. So it's quite detailed, but we can also go and get those two numbers really easily. There's the total liabilities, there's the total assets. Let's plug them into our formula, and we can see that their debt ratio equals 67%. Well, what does that mean? Well, we know that it means that 67% of the firm's total assets have been financed with debt. So to keep it real simple, if their balance sheet, for every dollar that there are of assets, that means there's 67 cents of liabilities and only 33 cents of owner's equity. So 2/3 of the business has been financed with debt. That's not a good ratio. That's got a lot of debt, and that would explain why a lot of people think this business isn't going to survive. Another really important ratio we learned about was the working capital ratio. It looks at, can we meet our short-term debts as they fall due? And that was calculated as our current assets divided by our current liabilities. Again, real simple. We can go and get that from the balance sheet. So there's our total current assets, there's our total current liabilities. We put them into our formula, and we end up with a working capital ratio of 1.23 to 1. Well, what does that mean? That means that for every dollar of current liabilities, the business has $1.23 in current assets to pay them. So again, keeping it simple, if we had a balance sheet, that means that if there's $1 of current liabilities, there's $1.23 of current assets to pay them. Now we need that ratio to be bigger than 1, so that's kind of successful from that standpoint, but there's not a lot of leeway there. That means that every dollar that's owed in the next 12 months, there's only $1.23 to pay it. So they're cutting it really fine here with their liquidity. So I guess when we look at the graph now, we can see and start to make a bit of sense. Why has this company gone so badly on the share market, and why have its shares been suspended and an administrator appointed? Well, we can see it's got a lot of debt, 67% debt ratio, and it's going to really struggle to pay its short-term debts. Now, when you can't pay your debts, that means you are broke and you are out of business. So the future, so looking at some quotes from the article, Dick Smith may struggle to refinance its debt and is at risk of going under. So what does that mean? Well, if you can't finance your debt, you can't pay it. And we saw the ratios kind of prove that. The expert quoted in the article is from Forager Funds. His name's Steve Johnson, and a couple of quotes from him are, the announcement is very negative. This could in fact be the end of the road for Dick Smith's. The combination of weak sales and, most importantly, a weak balance sheet could prove lethal. What does a weak balance sheet mean? That means it had a lot of debt compared to its assets. And in particular, we looked at the liquidity. It's just got a lot of current liabilities and not very many current assets with which to pay them.